What's up, tax savers? So I want to come in and start doing some Q&A and bring answers to you on a more regular basis. If you've got any tax questions, shoot me a message there and probably get answered here. All right, so we got someone asking here, I have a question. So I registered my business as an S corporation and I've gone throughout the whole year without paying payroll. So as you know, you should have an officer salary as an S corporation. You may or may not know that, but you should. I've made about $190,000 this year, and my understanding is I need to pay myself a reasonable salary. That's correct. Is it too late to do that, and what's the best route? So, number one, no, it's not too late. So right now when I'm filming this, it's before the end of the year. It's December 18th. This will go out in a couple days. As long as you can do it's better from an audit standpoint to have a regular salary throughout the year. But if you went and suddenly, 9 months went by, especially, in 2020, and you forgot to pay yourself a salary and get on this, normal kind of routine basis, you can issue yourself a bonus at the end of the year to get up to that reasonable salary. And it's not best practice, but it is best practice. And then just make sure that moving forward, you do things correctly and figure out what your annual salary should be and divide that by 12 and pay yourself a monthly salary going forward. And so when you're looking at what should a reasonable salary be, that is going to be the classic CPA answer, which is it depends. But the best way to find that out is it really depends on your location of where you live, because every market, if you're living in Omaha, Nebraska versus Manhattan, the same job is going to pay different, right? So you go to your state Department of Labor or your specific city on like a salary.com type of website, and you look at what your job is in your location, going to take the salary range and go kind of in the low mid side of that. And then that's what you pay yourself as a reasonable salary. So that's kind of how you look at reasonable salary. From a tax minimization strategy standpoint, if you have an S corporation, the best target reasonable salary is 2/7 of total profits in the business. So if you have $140,000 in your business, 2/7 would be a $40,000 salary. So kind of look at that for your tax target, and then see where your range is on what's reasonable based on your job. A doctor, probably you're not going to be able to pay yourself a reasonable salary of 40 grand. But if you work in, the arts where you're a successful artist, but most artists, are working for pennies, then you could probably get away with a little bit lower salary. So that's what I would say on the reasonable salary side of things. In instances, we got some good S corporation questions here. So in instances where the profit and loss percentages are not in line with ownership percentages, is there another option aside from an S corporation? So I think what the question here is asking is, with an S corporation, you have to make distributions proportionate to ownership. So if you have a partner that you own 80% and they own 20%, and you're, regardless of salary, we're talking profit distribution. So let's say the business profits $100,000. You have to take $80,000 in distribution. If you're distributing $80,000 of profit, you have to take 80, and they have to take 20. If you both take 50 and continue to do that over time, your S corporation designation is going to get disallowed. And you'll become a C corporation, which is all kinds of no good because it makes you subject to double taxation, and that's a whole different topic. But bottom line is, if you have an S corporation and you're making profit distributions, they have to be in line with the percentages of your ownership. So if you have an S corporation and you're giving different distributions, that needs to be paid through a wage, or you need to then look at possibly being a C corporation or some other type of entity that doesn't require that pro rata distribution. Now, if you've gone for a couple of years where you've done unequal distributions, that's okay. Just document in your minutes that you have plans to make it whole. So it's okay if you do it temporarily, as long as you have plans to make the distribution whole eventually. But that is a key gotcha if you have an S corporation with multiple owners. It's got to be proportionate to ownership. Hi, Tyler. I'd like to find out if switching from an LLC to an S corporation would benefit my finances. So the big key here is you can actually be an LLC and be taxed as an S corporation. If it makes sense to be an S corporation from a tax standpoint, you don't have to liquidate your LLC and then form a new entity. You can actually just make an election to be taxed as an S corporation. And the driver of that is going to be, does the savings, the self-employment tax savings that you get, which is 15% of your net income up to $133,000 on top of income tax, is the savings of switching to an S corporation going to offset the extra couple grand a year of cost that you're going to have to maintain it? And usually in most states, in most cases, the break even is around $60,000 to $80,000 of net income. And there's a few states that aren't great for S corporations. So this is going to be, if you're right in that range, in that wheelhouse, and you're not an S corporation yet, either reach out to us, shoot me a message, or talk to your CPA if you've got one and ask them if it might make sense for you. All right. Hi, we are looking for coffee lovers to be brand ambassadors for our recycled coffee cup brand. Please message us on our main account. Oh, I do love coffee, but no thank you. Thank you, though. All right, and another question, someone asked about Section 179 expense. So can you talk more about, can you make a post about Section 179? That's where you get 100% of a deduction in the current year if you buy it. And how to take advantage of that. So that's related to vehicles. So if you buy a vehicle that's over 6,000 pounds, so like a Ford F-150 or a Chevy Tahoe, or those are kind of the two that come to mind, or anything bigger, a big work truck. If it's over 6,000 pounds and you use it for more than 50% business use, then you can deduct 100% of the business use in the year you buy it. So let's say you buy the truck for $25,000 and you use it for 80% business miles or 80% business use, then you get to deduct 80% of $25,000. It's a $20,000 deduction in the first year you buy it. And that can be a great way to get a big deduction, especially if you finance the truck and interest rates are super low right now. So if you put $2,000 down and finance the $23,000 and you make payments over the next 5 years and you get a $20,000 deduction now, you save, call it $8,000 to $10,000 in tax, and you're only out $2,000 right now. That can be a really sweet deal from a cash flow standpoint. Now, I never advocate buying a truck just to buy a truck just to get the deduction, because then you're spending $25,000 to save $10,000. And it just, that's like, going and buying something on sale, that pair of shoes at the mall because it's 35% off because you can't afford not to buy it for 35% off. And so don't buy something just because it's at a discount. But it can be a great way to get a nice new car at a discount. So speaking of vehicles and auto use and business use percentage, this might be helpful for you related to do you use it more than 50%? So the way that you track the business use percentage is based on miles. And so it's business miles divided by total miles is your business use percentage. And commuting doesn't count. So if I'm driving from my house to the office, and that's a 10-mile commute, that doesn't count as business miles. If I'm driving from the office to a client's office 20 miles away, that's business miles. If I'm driving to a conference, that's business miles. If I'm driving to Costco to go pick up some computers from Costco or from Best Buy or from any of these stores, that would be business miles. And so you track your total miles and your total business miles, and whatever the percent of business miles is your percent of business use. And so if you drive 12,000 miles in a year and 8,000 of those are for business, then that's a 67% deduction, 2/3. And so then that's over 50%. And then in that case, 2/3 of your fuel purchases, 2/3 of your car insurance, 2/3 of everything you do with your vehicle is deductible. And that's, of course, if you're taking actual expenses. If you take mileage expense, then it would just be your business miles times the mileage rate of like 58 cents a mile. And then that would be your deduction. And almost always, the actual expense method is better than the mileage method. So that's how you determine business use percentage and whether to take the miles or Section 179. Let me see if we got anything else. Yo, what's good, bro? Appreciate the love there. Question: are you personally taking on new clients? We are. If you've got if you want help, and you're a business owner, reach out. We'd love to help you. I think that's good right now. So appreciate you watching. Let me know if you have any questions on any of this below, and please go and give me a follow on Instagram. That's where I'm checking the most. Or if you prefer, being in your phone and texting that way, you can text me to 916-249-1021, and I'll answer your your questions via text there. And I'm texting tax tips all the time. So give that a like, and we'll see you next time.